There will be mass layoffs. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Walmart and Amazon are about to do the unthinkable, but the Biden administration says, no way. And is Vanguard's big gamble going to pay off? We'll show you why it's not. Plus, home builders are making the same mistake they did right before the global financial crisis. I'm going to show you why they're going to send home prices crashing. And we're also seeing the first signs of demand destruction hit the global economy. At the same time, central bankers are panicking. I'll show you why the Fed believes that the U.S. economy and the U.S. labor market is about to get much worse. Now let's head over to the New York Times, where we picked today's story up with the headline, as new tariff rules could reverse a paradigm shift in retail, as now we see companies like Amazon and Walmart are under pressure from Chinese companies that are undercutting their prices. And I'm going to show you why this is going to lead to mass layoffs if Walmart and Amazon has its way. And this is a big reason why the Biden administration is stepping in to block this from happening. Major American retailers, including Amazon and Walmart, have been quietly exploring shifting toward a business model that would ship more goods directly to consumers from Chinese factories and require fewer U.S. workers at retail stores and logistics centers. And the risk here isn't that we're going to see fewer people needed at, of course, the store level or the logistics center. Think about small businesses. They won't be able to compete with these even cheaper Chinese goods. They're going to find themselves in a situation where many of them will shut down. And the plans have been driven by the rocketing popularity of Chinese e-commerce platforms like Shein and Temu, which have won over customers with their low prices. And what they do is ship inexpensive products directly to consumers' doorstep. And what this allows them to do is bypass American tariffs on Chinese goods. And normally this is a good thing, because when we see a rise in imports, it's usually a good thing for the U.S. economy. But we can look and see where periods where there's a decline in imports, you see it sends the unemployment rate up. And this could be the first time we actually start to see imports increase. At the same time, we see U.S. workers lose their job. And this is very dangerous, because there's absolutely no way American retailers and wholesalers compete with Chinese companies direct shipping goods. And this is going to force companies like Amazon and Walmart to change their business model. Again, it's going to lead to more people losing their jobs. But what I think is a bigger issue here is that small businesses have absolutely no way to compete. And rising competition from Shein, Temu, and other Chinese companies is pushing many major U.S. retailers to consider shifting to a similar model to qualify for an obscure central U.S. trade law. And the law known as de minimis allows importers to bypass U.S. taxes and tariffs on goods as long as shipments don't exceed $800 in value. In an announcement Friday morning, the Biden administration said it would clamp down on the number of packages that come into the country duty-free using de minimis shipping, particularly from China. And it won't be just China that this happens to. It's going to be every major country, because something Chinese manufacturers are doing is they're going and warehousing items in Mexico to get rapid direct shipping to America to beat other companies like Walmart and Amazon, who will not be able to compete on price. And so you look at what the Biden administration is doing here. They're trying to protect U.S. jobs in a huge way, because if this continues, it's going to send a lot of Americans to the unemployment line with absolutely no chance to find work. And this is coming at a time where we're already seeing a slowdown in demand. As we look at this chart here, we see retail sales that are inflation adjusted, or real retail sales in blue, against the unemployment rate. And we can see when there already are a slowdown in demand where retail sales decline, that sends workers to the unemployment line. And what we're going to see is companies like Amazon and Walmart, who have major power in the retail space, are going to look to duplicate this, put even more people on the unemployment line. And as the global economy slides into recession, with everyone believing that the U.S. economy was going to hold up, well, this is a dangerous move at this time. I mean, there's a reason why we see the Biden administration trying to stop this, because if they don't, it could make the next recession even worse. But Friday's action may head off a change that has been looming in global retail, as Amazon has been preparing a new discount service that would ship products directly to consumers, allowing those goods to bypass tariffs. Walmart has declined to comment, although Amazon did say that the company was always exploring new ways to work with our selling partners to delight our customers with more selection, lower prices, and greater convenience, and this will come at the sacrifice of small businesses and many U.S. jobs. But let's turn to Vanguard, who's now making a big gamble on the dollar as they buy dollars, saying the Fed rate cut bets have gone too far. Well, that shifted today. We'll talk about what the Fed did, but if you're looking to buy dollars or anything for that matter, this is all about making good decisions with good data, and we give that to you. We have two programs. One's called CTA Timer Pro, the other Momentum Timer Pro. If you're looking to trade, we focus on quality, not quantity. We make it easy to trade. You don't have to spend all day in front of your computer. Right now, our CTA Timer Pro has 7 open trades. 5 are up. That's a 71% win rate. But look at this. On September 10th, we bought PPLT. 7 days later, we are out of it. 3.73% return. Look at that. Huge return in 7 days. Momentum Timer Pro added a high-risk trade today. But how do we do this? We look at the machine positioning. When the machines are deep short and price moves against them, it flags our report. We consult our complete table of backtest data to confirm which signals are the best, and we give all the data to our subscribers. But maybe you like to trade momentum. Well, we look at momentum over longer periods, and we see a shift in momentum. That flags our reports. But here's the best part. You get the daily report. You get every single signal. You get my opinions on which ones I think you should do. I give you stop loss levels. I track all the trades, the goods and the bad ones. We update every week your stop loss levels. You can duplicate this each and every trade perfectly. The best part is, unlike my buddies who want you to pay, we give you 30 days for free. Why is that? Because we know you'll make money. That's key. Links in the description below, because we've seen a significant short position built up on the dollar. Well, if we thought it was time to buy the dollar, our reports would be telling us. We told our subscribers not to do this, but the data in the U.S. remains robust. Well, that's changing as we speak. Unless data deteriorates significantly from here, we believe the Fed will deliver fewer cuts than what the market expects. And I disagree with Vanguard on this, because when we look back at history, the Fed tends to cut and then they continue cutting. There's a few points here back in the mid-60s that they cut and they turn around and hiked again in a big way. You can kind of see here kind of around the mid-80s before they started hiking again, or even around the mid-90s where they cut a little bit. But most time they start cutting rates, it's a big deal, and the market believes it leads to a weaker dollar. Now, the reason it does, and sometimes, is because lower interest rates should spur credit creation. That creates dollars. But the market believes that actually the Fed and other central bankers have power over their currency. We don't believe that because we know they don't. But nevertheless, as the market starts to price in more and more cuts, it's going to send the dollar lower, and we think Vanguard's big gamble is going to be a dud. But let's talk about what's going on with home builders, because they're making the same mistake they did right before the global financial crisis, and why many homeowners believe the price on their home is good and can't go down. I'm going to show you why it's likely to tumble. As U.S. housing starts now increase to the fastest pace since April, as new construction rose a whopping 9.6% last month to 1.36 million annualized rate. This is now again the fastest since April. The report showed overall building permits, a gauge of future construction, also rose 5% to 1.48 million annualized rate, while single family authorizations increased to a 4-month high, on the whole notion that if the Fed cuts rates, that this will be a boom for the U.S. housing markets, that the only thing that was keeping people back from buying a home was just the fact that they needed rates to come down just a little bit. And we think rates need to come down a whole lot more. The problem is housing prices are going to go with it. And builders are awaiting a sustained pickup in demand to help work down an inventory of unsold homes that's hovering near the highest level since 2008. Now, you look back, and this was a big issue because at that time they believed if you build it, people will come. They didn't, and that was a problem, because what happened is builders have a much larger margin in their home. They start cutting prices to clear out their inventory, and it absolutely destroys the resale market. That's what happened then. Many people say it won't happen again. I'm going to show you why, because at the same time, mortgage rates have fallen to the lowest level since 2022. on expectations that the Federal Reserve will ease monetary policy, which they did today. And that's seen underpinning sales and helping to chip away at inventory, or at least builders are hoping. And they're hoping by so much that they decided to go break ground on new homes and take out new permits at a time when they have a massive inventory level. But if we're headed into recession, and that remains the case, the builders are facing a major problem that could send housing prices crashing, because we're looking at the federal funds rate against new privately owned housing starts here in blue. And what do we see is when the Fed cuts rates, it often leads to housing starts declining as builders find out they have too much inventory and not enough demand. And we see that happen repeatedly. Now, there is a case here in the 2000s where there was such a demand for the boomers for housing that a cut in Fed rates and a recession didn't stop them from buying homes. But look at the global financial crisis. You see the Fed cutting, and that downward trend that started back in the late 2000s actually just accelerated to the downside. The low rates didn't help the housing market at all. Now, it did help going into the pandemic, but this time everyone believes that if the Fed cuts rates, housing market is going to turn around as people can afford prices now, because all they needed was a little bit lower interest rates. The reality is, when we see that wage growth is slowing, we see hours worked declining, that means, of course, workers can't afford homes. And what's going to see here is builders are going to go into the next recession with a massive amount of inventory. They're going to be forced to dump onto the market. It's going to depress prices and send the housing market crashing, just like it did back during the financial crisis. Now, let's talk about demand destruction, because we're starting to see signs of that around the global economy as VW and China partner SAIC set to close car plant as sales shrink. The company's 4-decade-old venture with SAIC Motors is preparing to close a factory in Nanjing as soon as next year. The site, which makes VW, Passat, and Skoda cars, has an annual capacity of as many as 360,000 vehicles, and this is already a problem for Volkswagen, who has a capacity issue in Germany. The issue is they don't have enough demand to fill their capacity, so they're also looking at closing a factory there. You start talking about why the housing market is likely to crash. It's because there's demand destruction. We go back to the pandemic, and what happened? We shut down the global economy, we lowered interest rates, we lined people's pockets with money, they cleared all the shelves, and when the economy started to reopen, well, this was a huge boom for manufacturing, sent inflation higher, and then everybody started to hire people, believing that we were in the beginning of a new paradigm, a new normal, where demand was just out through the roof. And reality is, without all the stimulus and low interest rates, demand is going away, and what we're seeing then is factories likely to close, many jobs will be lost, and this is a problem because the housing market just won't hold up, and neither will the global manufacturing sector. And VW is reassessing its Chinese footprint as it also weighs plant closures at home, highlighting the complex challenges of the company as it must navigate to stay ahead of a perilous and uneven global transition away from fossil fuel vehicles. And maybe it's just their mistake of not seeing the EV revolution, or maybe it's the fact that there are changes now in the global economy where demand is going down, not up like everybody thought, but back to a new lower normal. At SAIC, VW alone, factory utilization last year stood at around 58% of a 2.1 million car ceiling. Scaling back would save costs for its co-owners as they seek to strengthen their hand in EVs. And this is something that we're seeing in the regional Fed surveys, where notably capacity utilization is declining. This is a red flag, because when this happens, it means more workers lose their jobs. And this is exactly what's happening in China as this factory faces potential closure. It's the same thing that's happening in Germany as VW molds a closure of factory there. And as we look to the U.S., we see periods where capacity utilization, shown in blue, declines. You can see that against the unemployment rate in red, and they're a near mirror of each other, that as capacity in the manufacturing sector declines, more Americans lose their jobs and don't have an opportunity to find work because there are no other jobs. And that's the real risk here as we continue to see a slowdown, that what's happening in China is likely to spread to the rest of the world. And this is why we see today the Federal Reserve start to panic and cut rates, because they know they're way behind the curve. In fact, I'm going to show you, they think things are going to get worse. And recent indicators suggest that economic activity has continued to expand at a solid pace as job gains have slowed and the unemployment rate has moved up but remains low. Inflation has made further progress toward the committee's 2% objective but remains somewhat elevated, and for that reason they are going to cut the funds rate today by 0.5 percentage point, and in considering additional adjustments to the target rate in the future will be based on incoming data. As always, the evolving outlook and the balance of risk. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, or what's known as quantitative tightening, despite the fact that my prediction is they would announce that this was coming to an end. It's possible that they're going to actually see what the market's response to the 50 basis point cut is, and then in the weeks to come, perhaps send some trial balloons that they're thinking about cutting quantitative tightening out completely. We'll find out, but the Fed here is really concerned about the economy. Let's take a look at their projections, because it wasn't long ago that Fed Chair Powell said he thought the unemployment rate would peak around 4.2%. Now they believe it's going to get up to 4.4 this year, stay there next year, and only slightly decrease by 2026 and into 2027. And this is dangerous because what they're saying is this soft landing narrative isn't happening, that the economy as we see it today is what we should expect going forward. And this is a problem because the economy isn't actually getting better. And why people like Vanguard actually thought the Fed wouldn't be cutting rates much, here we can see the projections now as over the longer run down to 2.9% by 2026. Of course, we know the Fed's going to blast through that level and likely get down to zero here by sometime next year as the economy continues to head into a recession. But if there was a reason why the Fed cut rates today, it had everything to do with the market telling them they needed to. As we look at here, 6-month Treasury yields shown in red against the federal funds rate in blue, and you can see the very strong relationship to the point we don't even need the Fed to set policy. They're a complete waste of time. All we should do is just tie the funds rate to 6-month bill yields, and here's what you can see: yields crashing down, Fed playing chase to the downside, and likely to set up more rate cuts in the future, because what they're realizing is if they believe that the unemployment rate is going to peak at 4.4%, well, watch out. They continue to raise that bar each and every meeting. The problem is the unemployment rate continues to go higher, and based on all the evidence we're seeing, it's going to actually get far worse than it is now, as more Americans likely in the months to come hit the unemployment line, who will spend less and lead to further demand destruction. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.